Sensex touch 1 lakh points by the end of this year, 2024? Well, that's what we're asking on this edition of In Your Interest. Veteran emerging markets investor Mark Mobius believes that the Sensex could touch 1 lakh by the end of this year, a bold prediction that suggests a potential upside of nearly 20% in the final 3 months of the year 2024. Now, for those unfamiliar, Mark Mobius is a legendary investor with decades of experience in emerging markets like India. He's been a strong believer in India's growth story and has made significant investments in Indian stocks over the years. According to Mark Mobius, while there may be a few bumps on the road to that 1 lakh mark, he is confident that these challenges will only be temporary and that India's stock markets will continue their bullish momentum in what he calls as a long-term bull market. So far, for the year 2024, the Sensex is up over 16.5%. Impressively, it has delivered positive returns every year since 2015. In fact, the index has only declined once annually since 2012, with average annual returns of 17%. Now, we have some special guests joining us to help us understand this better. We have Mr. Nishchal Maheshwari, market expert, joining us. We also have Mr. Rohit Srivastava, founder and market strategist, IndiaCharts.com. Gentlemen, thank you so much for taking time out to be with us. I'm going to begin with Nishchal Maheshwari. First thoughts, Nishchal, from you on Sensex at 1 lakh by the end of the year. Mark Mobius does couch his argument by saying the fact that in the course of the bull run, there will be 5 to 10 to 15% corrections. But the fact of the matter is that we have just about 3 months left. Do you think the Sensex will touch 1 lakh by December?
So, I don't think so. It is far from imagination, basically. The market done the last 3 years. And all of us, at some point in time, 50,000 seemed to be a far cry, and then 50 and 60 and 70, and we are now 80. So I'm saying basically the momentum is there. There is huge amount of liquidity, basically, which still continues to be there. And now, fortunately, the liquidity is being taken care of by the supply in the market. So I don't think so that it is very far-fetched. But what we have to see is basically two things. What will be the outcome of the US election? I think that carries a lot of weight. And secondly, how aggressive is the US in cutting rates? But I do not see that this is not within our reach.
Okay, Nishal, stay with us. Let me quickly get a similar reaction from Rohit Srivastava. Your first thoughts, do you think that Sensex at 1 lakh is not exactly far-fetched? It's very much a possibility at this stage.
If we put a time and price to it, then it does appear difficult, because if I say by this year end, that is December of 2024, getting to 100,000 or a 20% move is something we have really not seen in any particular calendar year for several years now. So it's a very, very tough call to really make that you'll do it in such a short period of time. However, we can imagine getting to the 1 lakh Sensex mark eventually, given the trajectory of growth, given the trajectory of interest rates, and the situation that India is particularly in within the global context. So there is a clear sign that we are headed in that direction. But putting a time on it is, and especially such a short period of time, I think is a very tough job.
Okay, tough job. We also have another very special guest now joining us. We have Mr. Feroz Aziz, Deputy CEO of Anand Rathi Wealth with us. Feroz, thank you so much for taking time out to be with us. Mark Mobius says Sensex is going to touch 1 lakh by the end of this year, as in this calendar year 2024, which means in 3 months' time, Sensex will touch 1 lakh. Agree or disagree?
Oh, I don't know. Like you rightly said, Mark Mobius, who's the father of emerging market investing, and I've been fortunate to spend about a couple of hours with him last November when he was in India to understand businesses. And he looks at not just valuations of a business or a market, but also looks at the liquidity, which I think the domestic guys miss out. So to answer your pointed question, 1 lakh possible? The answer is, of course, it's possible. But I think investing is about probabilities and not about possibilities. Possible for sure, but is it high probability? I would say no. Within this calendar year, unlikely. But in this fiscal year, yes, mostly possible. and all will hinge around what kind of earnings growth transpire. Will we be able to achieve 1,100, 1,200 earnings for Nifty this year is what will determine whether Sensex will reach or Sensex will reach almost about a lakh or not.
You know, Feroz, I was asking a pointed question because as we speak, you're witnessing profit taking in the markets in Sensex at 85,000 levels. So, you know, in that sense, you know, when there is profit taking at all levels, this is a very tight timeline for the Sensex to go from 85,000 levels to 1 lakh.
Yes, definitely a very tight timeline. We're already in October. But having said which, if you look at markets, variables help you understand where the market will not go much easier than where the markets will go. I have a fine point to be made here. Like on 4th June, when the counting was happening, the variables very clearly indicated that the market can't slip below 21,000. Is why I was vocal on live television at 11 in the morning in most of the channels, saying that markets can't slip below 21,000. It's easier to check where the markets will not go or relative to where they can go. That's point one. Point two, why is it still possible is because what is happening is domestic liquidity in index funds is expected to come. Indices are always top heavy. If you look at the top 10 stocks of Nifty, you will realize that 65% of Nifty's weight is in the top 10 stocks. If EPFO pumps in 50,000 crores, almost 65% of that, which is 35,000 crore, needs to be invested in 10 stocks. And because of that, they move further up. And because they move further up, their weightages go up. Again, the vicious cycle brings in more liquidity. More liquidity brings in more weight. This is what has happened to the US market, is why you see some large businesses at obscene valuations and never correcting, because liquidity is chasing the top stocks of indices.
Okay. Feroz, the reason why you're talking about this valuations is because that's another thing that's bandied about when it comes to Indian markets. The valuations are just way too high. And we're talking about a time when China has just gotten a brand new stimulus package. Suddenly, China has become extremely attractive because, you know, after the poor performance during COVID and the slow post-COVID recovery, China looks like a really good bet at this stage with the kind of support it's gotten from the government, with the kind of support it's going to get for troubled sectors in the Chinese economy. So a lot of money will go to China going forward. So in that sense, do you think India is at the threat of losing out?
I don't think so. Why don't I think so is it's not just the issue of performance when it came to China, not just the issue of economy doing well or not doing well, what the real estate sector has as a spill-off effect. What has happened post-COVID is China has lost some degree of credibility to attract capital, foreign capital. I've been going to an investment conference for the last 8-9 years in Paris, and every time I've tried to gauge the competitive relative attractiveness between India and China amongst all those 500-600 fund managers and wealth managers who come there every year. The last 2-3 years I've seen it's not just about performance, it's about confidence on the market, capital market, and the regulation and the flexibility and the ease with which you can operate in a capital market. Business friendly but not capital market friendly is how China is currently defined, or at least is perceived to be post the COVID happening.
All right, Feroz, stick with us. Nishchal, if I were to ask you that question, Chinese stocks are better value today than Indian stocks, are cheaper than Indian stocks, lesser premium on Chinese stocks as compared to as compared to stocks in India. So, do you think that there is that threat that the Indian markets face with the revival of China?
So Chinese stocks have been cheap for the last 5 years, actually. If you look at the last whole decade, China has been a lost decade as far as stock market in China is concerned. And it has nothing to do with India, basically. It is their more internal problems, basically, one after the other. There was a cleanup with China, data pollution, thereafter issues about corruption, and thereafter, and both these things have actually put a lid to their consumption. That's why I think the economy is in a mess at every new year they come with a new package, basically, just to revive the economy. But I still think it's too far off to call that China is on for a revival path. And again, I don't think so India will be much impacted, because if you look at it in the whole, this big rally basically, except for the last few months, FIs have been negative in India, negative flows continuously. So it is the domestic money which is driving the market, and I don't see that going away in a moment. At least for the immediate future, I don't see any reason for that money to go away. So do not see much impact of China revival.
Rohit, would you concur with that? A revival in China is not necessarily a problem for India's bull run.
Yeah, so there are a couple of things to consider there. First of all, is the worst over for China? I mean, it's a thought that's been on my mind for quite some time. We've only seen it play out now, because sooner or later this was going to happen. In fact, the weakening of the, strengthening of the yen, which was associated with that one interest rate hike and created a lot of hue and cry on the yen carry trade. The immediate, forecast that a lot of hedge funds were making was that this has created room for China to stimulate, because now the fear of a weaker yuan is, out of the way. So that's sort of what has played out in the following weeks. The good news, so that means, is that China does well. Is that bad news for us? The answer is no, because China's part of, for a lot of people, it's part of either an EM allocation or some kind of a global asset allocation towards Asia. And you don't usually invest, only in a single country. I mean, we don't say, okay, sell China, buy India. That's usually not the trade. The trade is typically that, okay, let us increase the weightage somewhere, reduce the weightage somewhere. But the attractiveness of China, what it really does is it increases the availability of flows that will happen towards EMs or towards Asian markets. And India will be part of that basket. So positivity is only going to help, everyone, rather than only one particular part of the, continent.
Feroz, even as Mark Mobius spoke about, Sensex hitting 1 lakh, he did give a couple of qualifiers. He said that hopefully SEBI's moves to crack down on F&O and derivatives trading does not prove to be a dampener. Do you think they will be?
I don't think so. It can't be too much of a dampener. Depends on the shape and form. What I liked about the circular yesterday, which came at 9:20, 10:30 in the night, was the fact that before curbing retail participation in F&O, the regulator has first tried to give the solution of new strategies under the mutual fund platform. If both of those things happened in the same circular, I would see it as an unfair circular, because first, the regulator is saying, why don't you establish a platform where derivatives can be more liberally used relative to the normal mutual fund? And once that is established at as little as 10 lakh rupee an amount, then you will definitely see this as a precursor for clamping down. That's point one. Point two, I personally think the retail investors in the derivative space are bound to lose money, because retailers, when I speak to in some of these educative events, they don't even know derivative Greeks. They don't know delta, gamma, theta, rho, vega. These are basic education you need to have before you sit on the terminal trading a derivative. But the institutions have done mastered courses of hedging Greeks, or looking at algorithms, looking at AI to create and induce volatility. So it's an unfair game between a retail participation who doesn't even understand basics of option Greeks, and another institution who's definitely going to make 1.8 lakh crore, because he understands what he or she is dealing with and the price impact of each of the variables. And I'm very happy that SEBI is trying to make sure that there is some deterrent for the retail space. And I don't think that will impact the cash market, because derivative market volumes have gone through the roof, and that will not impact cash market volumes, which is about 1,20,000 crores a day in the NSE platform. I think so. Largely, not too much of an impact if it doesn't come very rude as a shock.
Okay. Mobius' top bets when it comes to sectors to invest in are infrastructure, housing, and pharmaceuticals. He thinks that that's where the real growth is going to come from. I want your thoughts on that, Feroz.
So I think pharmaceutical, definitely yes, because I think the pharmaceutical industry is going through a paradigm shift from generic to some degree of innovation in India. I think that is definitely a sector which a mutual fund investor can participate from a structural change perspective. But I am very bullish on the capital market index which got created, which has businesses, about 15, 20 businesses, which are capital market related, be it asset management companies, be it wealth managers, be it rating agencies, and any capital market related business. There was an index created. I'm reasonably bullish on that sector, but I should give a disclaimer that our stock is also a part of that index.
All right, Nischal, I want your thoughts on the possible bull run, the long-term bull market that he's talking about, that Mobius is talking about, with particular these sectors earmarked as if you are looking to put money. He's even talking about the fact that if you are holding on to cash, you should look to buy in the possible dips that might come up. Mobius himself says there could be dips of 5 to 10 to 15% going forward in the long-term bull run that we're in.
Yeah, I think it is so basic. If you look at any bull market which has happened historically in the last 50 years, I think you'll always keep on getting corrections. And these are very healthy corrections basically because the weak hands get knocked off in the market. And I think that's healthy for the market. As far as sectors are concerned, I think interest rate cutting cycle has started. I think it will take a bit of time in India to start it. But I think interest rate sensitive sectors should be looked at very closely. So yes, that's why he's talking about the housing and infra. But I would be also positive on IT basically because the interest cut in the US basically is going to induce demand in the US economy and thereby in IT. So IT should be a positive there. BFSI is another one basically in an interest rate cutting scenario. These are all the positives basically. Auto is another one. So I think all the interest rate sensitive sectors, one should be positive on interest rate cutting scenario.
All right, Rohit, interest rate sensitive sectors is where the focus should be ideally going forward. We're talking about this at a time when India is yet to start its interest rate cutting cycle, whereas China and the US both are in the middle of loosening up their interest rates as much as possible.
No, I'm definitely sure we'll have to follow in the same direction as far as rates are concerned, because if we are supposed to trigger the next cycle and actually head towards the 1 lakh mark that you're really talking about, it's not going to happen without rate cuts, because you do need credit to really pick up on the entire stream. And moment that happens, you will see interest rate sensitives actually start doing well. And I would also highlight in that metals, not just autos, realty, infra, which are the obvious candidates, or banking, which is actually one of the undervalued sectors to really look at. But also metals, because it's sort of triggering the commodity cycle all over again. We've seen commodity prices down for more than 12 months now, and somewhere that's going to pick up. I think we are at the fag end of the commodity cycle, oil being probably the weakest space. We've already seen some pickup in places like copper, aluminium, and so on. So I do think this entire process, the rate cuts, weak dollar essentially would trigger a couple of these segments in the market that would do well. But rate sensitives are where you'll get the growth push from the private sector, from credit growth actually taking off. So that I think is necessary and possibly coming in the months ahead. The real question is how quickly are we going to get there? How quickly is RBI really going to move and spark that swing? Then it makes it easier for us to really put a end goal in terms of when we are really going to get to the 1 lakh mark.
Right. Nischal, if I were to ask you, Mobius also talks about the fact that still it makes sense to keep 10% of your portfolio in gold, despite the astronomically high prices at where gold is.
So this is a very surprising thing basically, that at the same point of time when we're cutting rates, gold is also hitting a new high. So we are not clear basically as far as US is concerned whether we are going in for a soft landing or there is going to be a depression in the US. So that's what I think, that's why you're seeing this kind of gold prices basically, where some people are betting saying that US is not going to come out unscathed. And that's why you may see some amount of compression in the economy. So that's the situation. But at these prices, I'm no expert on gold, so wouldn't want to comment on that. But I think it's pretty high. I have no view on gold, to be frank.
Rohit, your thoughts on gold?
I think gold is in a long-term bull market, but there are two things to consider here. Would I own gold relative to equities or not? So there are phases in this. There are times when gold actually outperforms, like 2015 to 2020. Post that, we've actually seen equities do much better than gold. And so even though gold is in a bull run, till now I would have rather owned equities. Now there is a case to have some allocation towards gold at this point of time. And it's sort of, I think it's the first one that ends up reflecting the commodity cycle, which I was talking about. It's really impacted by two things, which is real interest rates and the dollar itself. The dollar is already weakening. And when you go into a rate cutting cycle, then real interest rates also start coming down. So gold reflects that first, and eventually it rubs off on the rest of the commodity pack. But again, the main question is, should I increase allocation to gold significantly away from equities when equities are doing so well? Most of the time, the answer is no. But right now, I think for the next quarter or two, while we are going through this transition between rates and the RBI taking measures plus the rebound in inflation, we should probably have some gold allocation as a safety hedge.
Fair enough. Fair enough. We will leave it at that. Rohit Srivastava, founder, market strategist, IndiaCharts.com. Thank you so much for taking time out to be with us. And of course, Nishchal Maheshwari, market expert, also for being with us here on this edition of In Your Interest. And with that, we've completely run out of time here on the show. Thank you so much for watching. This is Krishna Kumar signing off.